Okay, let's try to make a start here. Obviously not much power there. Right. Okay, is any sound coming through yet or not? No sound? No sound. Okay, is that better? Is that better? Is there sound up there? You want more? More? Okay, how's that? Is that better? Good? You guys okay? Right. Okay, so let's make a start. So we'll just briefly review what we did last time. Actually, we finished the previous topic, so we started on the options. And so an option, the type of derivative, a financial contract, which allows you to have the right, but not the obligation, to either purchase or sell a particular asset at a price that you set today at a particular time in the future. And they do come in the two broad categories, as a call and a put. And the call option is the one that grants you the right to buy the asset. So if you have a call option, there will be a price which is known as the strike price, and that allows you to buy the asset at that particular price, but there's no obligation to do so, and so you only use the option if it's profitable for you to use it. The other one, the put option, is the one that allows you to sell the asset at an agreed price. Again, that particular price is called a strike price, and so you would, because you have a right to sell it at the strike price but no obligation to do so, you would actually only use the option in such case that it was actually financially advantaged to you to use it. In terms of when you're going to use the option, the two types that we're going to consider in this course are just the European option and the American option. There are others, but the difference between them is that the European option can only be exercised at a time that it expires. So you buy it, and then it runs up to a particular date, maturity date or expiry date, and that's the date that you have to decide whether you're going to use that option or not. The other one, the American option, allows you to make a decision at any point up to and including that maturity date. So at any point, a long time from the time you buy the option until you reach that expiry date, including that expiry date, you can decide to use it at any point along there. So that's pretty much what we talked about. We did talk a little bit about the terminology. So if you actually buy the option, you're called an option holder. If you sell the option, because it always needs two parties to get it going, then they call that particular party the option writer. So a seller is the option writer. And so we're at this point here, thinking of the risks that an exchange takes. Why do you think exchanges are more concerned with writers of what we call naked options than writers of covered options? So perhaps we should address the first question is, what are these things? So what's the difference between a naked option and a covered option if you're an option writer? Ooh, all very quiet. Well, a naked option is one where you simply made no provision whatsoever to meet your obligations in the event that it's exercised. You've written this thing, either put or call, and you simply made no provision to do that. If someone comes along and tries to exercise the option, and so you essentially at that point will scramble to meet your obligations. Now, usually with an exchange, they won't let you go completely with nothing, and most of them have a system of a margin account, and you have to deposit money in if you're the writer. And the other thing that they can do, though, is when we talk about a covered option, is that when you've actually made provision for it. So one of the things that you can do instead of putting money into your margin account, if, say, you've written a call option, so someone has the right to buy the asset, they will actually allow you to deposit, say, for example, you've written call option on BHP shares. They actually allow you to deposit the BHP shares there in the case that it gets exercised. So it's very obvious that if you made no provision, then you have a much riskier position than if you've made provisions in either in terms of dollars or in terms of the actual asset itself. So typically, you can't actually write a completely naked option in terms of an exchange because of this system of the margin accounts. But in the over-the-counter markets, you can actually do that. So the options are traded on the Australian Stock Exchange and Sydney Futures Exchange, which actually is now merged as part of the ASX. They've got lots and lots of options. I actually looked up BHP this morning to see how many options there were on it, and there were 1,224 different options on BHP, or about equal numbers of puts and calls, huge range of strike prices, so you can pretty much get any sort of strike price you want on them. The New Zealand Stock Exchange is developing a derivatives market. It's still pretty illiquid. There's not much there, not many derivatives yet, but they're trying to develop a market here for the New Zealand market. And one of their ones that is reasonably successful so far is that they have options and other derivatives on milk products like skim milk powder, butter, and that sort of thing. So they've got a very small one here. Hopefully they hope that it will take off so they make more money on it. Okay, any questions on that before we go to the value of how would we value an option? Okay, so in this course, we don't actually do any of the maths about how you value that. If you go and do the derivatives course at third year, well, actually there you'll learn how to actually calculate the value of the option. So what we do here, we simply just sort of do it qualitatively, we basically describe what are the things that are important in valuing an option. So starting first one, what's the relationship between the time to expiry for an option and the value of the option, holding everything else constant? So everything else is constant. The only difference between two options is one has longer time to maturity than the other. How does that affect the value?
I think it's same to the maturity and the current price for bond.
Similar. So how would you say that?
I mean, if the maturity is long, I think that the price is supposed to be higher.
Yeah. Basically, the longer the time to maturity, the price goes up. So when we're thinking about this, start and draw a picture here. When you're thinking about the value of an option, there's a number of considerations that go into it. So along here, this is the price of the asset, and this is the option prices up here, and that's of course in dollars. So we'll do a call option because it's probably the simpler of the two to understand. So we'll make this a call option that we're going to try to value. Now, there will be an agreed strike price, which we call K in this. And if the asset price is below the strike price, what's your option worth to you if you actually had to exercise it? Or had a choice of exercising. This is a call. This is a call, not a put. So in a call, if the asset price was below the strike price, would your option have any value? Say it's a European option, we've got to the end of the thing, and we've got to make a decision. If it's down here, does it have any value? Zero. So up until between this point here and there, I'll make it blue, sit on there, it has zero value. So that's supposed to be sitting on that black line. So it has zero value to that point, and then of course, once you get above the strike price, so the asset goes above the strike price, and you had to make a decision, you're going to use that option or not, it has some value, and it basically simply files off of here. So this is the payoff of the option. So depending where the asset price is relative to the strike price, for a call option, if the asset price is below the strike price, you wouldn't use your option. You simply let it lapse without value, because if you wanted to buy it, you would actually go to the market and buy it cheaper there. If it's up in here, asset price is above the strike price, and you want to buy the asset, you would use your option because you can get it for cheaper. So this blue line together, when we're thinking about the pricing at some other time apart from the end, that's called the intrinsic value of the option. And it's simply what would be the value of the option if we exercised it now. Okay, before I start putting some other lines on there, any questions on that? Everybody's happy? Okay, so the actual pricing curves themselves, we'll put several on there. If the actual price of the asset relative to the strike price is either way up here or way down here, there's virtually no difference between the option price and the payoff. But particularly when the when the asset price is around the strike price, you get a significant deviation. And so the curves tend to look like this. So we'll put a few in there. So they sort of look like that. Okay, so I put several in there, and obviously that's the direction of the increasing value of the option. So the first thing we said is if the time to maturity goes up, then the value of the option goes up. So the option value increases with, first one is time to expiry. So that's what we just talked about. Now the second one, to explain the relationship between the price variance of an asset and the value of the option. What's the relationship between the value of the option and the volatility or the price variance of the underlying asset? Let's say the volatility goes up, does that make our option worth more or less?
Less.
Makes it worth less. Okay. Anybody think? How many think less? You think? Oh, do you make it more? Oh no, we've got an argument. Okay. How many people think it's going to make it worth less? One. How many think it's going to make it worth more? One. Oh my gosh. All right. Okay, so in actual fact, it does make it worth more. Well, let's look at why it is. So it goes up, the value goes up with increasing volatility. Now, the question is why? Seeing how we had an argument and two people took opposite views and nobody else knew, we'll look at why this is the case. So I'll draw a second graph here. Grab another bit of paper. And what we're going to do there, okay, so this is the price of the asset, whatever that asset may be. And up here we're going to have a probability. And for low volatility asset, the price, now let's make this simple. Let's say that the mean is going to be the strike price. So we're just going to make this easiest. We're going to make this mean of the payout, mean at the end equal the strike price. Now we can draw this for any other combination of means and strike prices, but if we make the strike price equal to the mean, then it'll make our diagram simple. So for a low volatility asset, you get some distribution like that. So there's your low volatility one. probability on vertical axis, asset or price of the asset on the horizontal axis. For a high volatility asset, or what tends to happen in things like stock market and so on, is that volatility changes over time. So although you might start out with a low volatile stock, you've got an option on it. If there's some market turmoil, volatility goes out, and so of course that will make the price of the asset change, option change. And so what you have is same mean here, is you have a much bigger distribution in terms of the price when it actually comes time to So if the asset has low volatility, it won't deviate very far from this price here. If it has high volatility, then it's where it's going to end up, has a much bigger spread. Okay, does anyone else want a question on this probability distribution before we actually go and turn this into a value? Okay, everybody's all good. So when you're thinking about the payoff, remember, if we put the payoff back up again, payoff is this blue line here. In the way we've drawn it here is that for half of the time, it'll have a zero payoff. Okay, so it's down here, and then it'll have some positive payoff if it's up there, and that's going to be the other bit over here. So what we're going to do now is we're going to, again, put a probability up here. And we're going to put payoff along there. Now, because half the time you're going to have a zero payoff, whatever this thing is, it's kind of hard to draw this realistically, but that's 50% there for your low volatile asset. 50% of the time you're going to get no payoff at all from your option. And then, of course, the other one is simply, the difference between the strike price and the asset price, that's your payoff. And so it starts at zero with high probability, drops away, and there's your low volatility asset there. And that will have some mean, or alternatively, expected value in a statistical sense. Now, for the high volatility asset, again, half the time you're going to end up with your option worth nothing. So we get the same 50%. I'll just sort of put it inside here. But again, 50% of the time you end up with your option worth nothing. But the other half, when you actually get it's worth something, is it sits out here, and so you have a distribution that's much flatter and goes out much further, but eventually tails away. And for that one, depending where it is, let's say it's here. So this is our mean, or expected value for that particular distribution of payoffs. Now, here's how we figure out what the option is worth. Option premium sets the next expected gain to both parties as zero. So looking at that, take the low volatility asset. What would you set the price of the option at? How would you set the price of the option?
Volatility is zero, so this is pretty much like the difference between the zero thing. So the price is
All right, okay. Well, think about that. The option premium is set, so the net expected gain is 0 for both parties. So what you have to do is you set your price to the mean. Now, we didn't put any dollars on there, but in one case, the mean's there. Okay? Low volatility, the mean is there. Other case, the mean is there. And the basic principle is, take those two things equals the option price. Because what it means is that, although in actual fact, when you start looking at it, it's a bit the problem of trying to figure out how this thing works is that the actual payoff is skewed. Okay, so 50% of the time you get nothing. Most of the time there's a little payoff, but when you think about the high volatility one, it's got quite a long tail there. And so most of the time, the option writer is going to get a little bit, okay? Most of the time they're going to get a little bit, but every now and again they're going to have to take a big hit. And so overall, there's this mean at this point, whatever that is in dollars. And if you're doing this thousands of times, and this was replicated as we expect thousands of times, overall there will be no net gain to either the option writer or the option buyer. So basically, you can work out from the statistics of the distribution and the volatility, a few other bits and pieces, what that mean is, and that's where you set the price. So you can see, just from the way we've drawn it and thought about it, that if you have high volatility, that makes the option worth more. Everything else being equal. Okay, any questions on that? Okay, everybody's happy. Right, there is one other thing that affects the value of the option. Put this one back on there again. And that is the interest rates. So and this one's probably pretty hard to guess as to which way it's going to go. But basically, particularly it's the risk-free rate, but if the interest rates rise, and in this case, everything else equal. So the value of the option obviously depends on where the price of the asset is relative to the strike price at the time that you enter into the contract. But basically, the longer the time to maturity or longer time to expiry, it's going to be worth more. The higher the volatility of the asset makes the option worth more. And also, as the interest rates rise, then it's worth more. So we actually split the value of the option in two pieces. One we've just talked about, this one here, this blue one, this is the intrinsic value. But let's say, for example, this is where it was today. That's where the asset price was there, and this is where the option was here. That thing there, even though very obviously it includes more than just the time, that's known as the time value of the option. That doesn't show up very well. Anyway, that says time value of the option. So when you're thinking about how much this is going to be worth, the price of the option is equal to the intrinsic value and that's essentially just the payoff that you would have if you exercise it today, plus what we call the time value. And those two things together give you the price of the option. And it's very clear mathematical descriptions exactly how you do this. So there's basically no real ambiguity around what the price should be for a given set of volatilities, time to maturity, interest rates, and current asset price and strike price. Once you have those things plug it into a formula called Black-Scholes and some of its modifications, and you come out with a dollar figure for what the option's worth. Okay, any questions on that? Okay. Right, so let's move on to, there's things for making pictures. Okay, so now we're going to think about how you can actually use these things both for hedging and for speculating. So here's an example we're going to look at. So an investor is in May, so that's next month. They own 1,000 Microsoft shares. Current price is $73. And what they're concerned about is that price of Microsoft shares could go down, it might fall substantially, and they're thinking about whether they should go ahead and perhaps hedge this risk that they think is out there. So you can see that when you look at the option price, it's got a $65 strike price, which is well below the current share price of $73. But even so, a 10th of July expiry, it costs you $2.50 per option to buy. So, given that, what would you do if you thought that was fair price and you really wanted to buy this protection? What would you do? Or would you buy a call or a put? Or would you write a call or a put? Would you write a call? No? Okay. So you worry about the price going down. The option that gains the value as it goes down is a put. So we draw that as to what the payoff would be for a put. So there's your payoff in dollars up there. And there's, in this case, is Microsoft. And there's the strike price. In this case, it's $65, and it will gain value below that point. Now, to buy it, you've got to pay $2.50 for it, but it starts to acquire value as it drops below that. And at this point here, $62.50, which is the $65 strike price plus your cost, you actually start to gain. So it actually becomes really worthwhile. It grants you some protection here, but once you get in there, it really starts to be worth having. So if they are concerned about a big drop in the price and they want to hedge that, there's various ways of doing it, but if you wanted to use an option, you want a put option because that's the one that gains the value for you. You want to go long on the put because that gains you value as the asset price goes down. So as Microsoft drops, in fact, they're over here at this point, 73 just at the moment, but they're fearing some big drop for whatever reason. And essentially what this does, it means that your 1,000 shares will never be less than $62.50. Oh, sorry, hang on, I'll show the other one. Sorry, that's right. Yeah, $62.50 because you can always get 65 from the option. And of course, that protection costs you your $2.50. And so you've essentially set the minimum value for your portfolio of Microsoft shares with option at $62.50. Okay. Above that, the value of your portfolio will fluctuate as the asset price fluctuates. Once you get to that point, $62.50, you'll never lose any more money after that. Okay. It doesn't matter whether the thing goes down to $40 or whatever. You basically put this bottom value on it. So if you're right, and the asset, in this case Microsoft, drops as you expect, then you can protect yourself with an option. But of course, that sort of thing, if it doesn't go down, your option will lapse without value, and you lose your option premium. So you have to pay for this protection if you want it. Okay. Any question on that? Right. Okay. So there's the thing there. It costs you $2,500, and you can sell them at least $65. But of course, you've got to drop off your $2.50 for the actual cost of it. So here's one for an example for speculating. Draw a picture for this one as well. So this one, they're going to take a call option. So this is a call option. So it's October. Speculator considers that Cisco is going to rise over the next 2 months. Share price currently 20. 2-month call option with a $25 strike price costs $1. So there's your strike price. In this case, it's $25 for that strike price. So that's the Cisco share price there, and this is your payoff up here. And so it costs you $1 to buy these, each one per share, to buy them. Once you hit that point, then your option acquires value. So if the investor is right, okay, and we end up with the share price rising to 35, so it goes way over here somewhere, then that option is going to acquire a lot of value for them. So let's look at the difference between how much money we would make if we purely invested in options versus purely investing in shares. Okay, so we can sort of see what the payoff there is. So let's look at the shares one. If you have $4,000 to invest, how many shares can you buy? $20 each. If you have 4,000, 200. And if it goes up to $35, how much do you have at the end? 7,000. Yeah. 7,000. So if you invested your $4,000 in shares, that's good return over that couple of months period, but you would earn $3,000 on it. So how many options could you get for your $4,000? I can get 4,000 because they're dollar a piece. So you get 4 of them, 4,000 of them. So with the shares, you're going to make this $3,000 profit. So if you buy the shares, buy the options, it costs you 4,000, but you can get 4,000 of them dollars. So if it went up to 35, what's the value of your option if it goes up to 35? Your strike price is 25. What was that? 40,000, yeah. Okay, because you've got 4,000 options. You're going to make $10 per option because the strike price is 25. It's now 35. $40,000 gross. And, of course, you have to take off the fact that it cost you $4,000 to start. So your net profit in this case would be $36,000. So you can see the difference between investing in shares would give you a $3,000 profit on your investment. Investing in options in this particular case is going to end up with a $36,000 profit, 12 times as much. So this is one of the reasons people get attracted to this stuff. If you get this stuff right, you can make a lot of money, certainly a lot more money than you can make in investing in the underlying asset. But of course, there's risks associated with it, which you've got to take account of. Okay, so I think there's the numbers. Any questions on that before we move on? Yeah, go ahead.
Like assuming you and I are the same market, we both know that the interest rate is gonna fall. Let's say it's gonna fall. That if you want to buy the options, why should I do to be the option? Apparently, I know that we all know that it's going to be a loss. I wouldn't kind of pay for the thing. I'm definitely going to lose.
Well, I'm not even sure if I know the answer to the question. I mean, when you look at the pricing and you say, well, your net expected gain is 0, you think, well, why do people do this? Even though we've got a guy in the department, a PhD student, he's coming to the end, who was actually an option trader, and I've asked him, why do you guys trade these options? He was actually a market maker. And he couldn't explain it to me in a way that I could actually understand. But here's another example where another business I don't understand either, is that casinos are our business. And if you walk in the door, it's stacked against you, you're going to lose money. And yet they've been going for hundreds of years. And I don't really know why people do this. If you want to try to make a rational explanation, what we would try to say is that your expectations about what's going to happen to the price are different to mine. You think you're going to make money, and I think I'm going to make money, but only one of us can be right. So I don't really quite understand why people speculate.
I just feel that this kind of problem is quite similar to the game theory in the economics.
Yeah.
I feel like the people could take quite significant advantage with asymmetric information. That, like for example, if I know nothing about it, then I'm definitely going to buy it, and I'm definitely going to lose money. And if you know something, then you're going to buy the options, and I'm going to lose money. You're going to get it.
Well, if there's asymmetric information and somebody has better information than someone else, then that person will stand to gain. But overall, I mean, these things, when you look at it systematically, is there a systematic profiting of the long position over the short position over a long period of time? The answer is no. Those prices are set pretty much bang on right, so that over thousands of replications, it comes out at 0. But if even the people who there are places that would claim they can train you to trade options, and I've never gone on one of the courses, but I do know people who did. And one person who did went on one of the courses about how to trade options. What they claimed was that they could put your chances of getting it right up from 50% to 60%. And that's all they could reckon they could do. But if you could do that, you can make a lot of money. But anyway, that particular person didn't do particularly well, so maybe the training course they went on might not be worth the hill of beans. So in one sense, I can sort of understand how they value this stuff, but it's like many of the derivatives markets, this huge amount of trading that goes on that I really don't understand why people do it. Because there's just not that much out there to hedge. When we talked about the derivatives markets being like 20 times the entire economic output of the entire world, there's just not that much risk out there to hedge. But anyway, people do this. I don't know why. Okay. So this is a bit of summary here. There's some things in it that are quite different to the call, to the futures. For example, if you're the purchaser, and this is the key thing, if you're the purchaser, you have limited losses, and you're simply limited to whatever that option premium is. That's your maximum loss. Whereas, if you go in futures, then it depends where the thing goes. But for a call option purchaser, there's basically no upper bound to your gain that you can make with a call option. Another key thing about them is that if you buy the call option, there's no margin requirements there. And simply because if you want to exercise your option, you have to put your money up. And it doesn't matter to the exchange if you would like to exercise your option and you can't. And so there's no margin requirement there. But on the option writer's point of view, from their side of it, they're required to make the payments to the margin account. If it's something like a financial asset, they can actually positive asset. But so call option purchasers, they can buy it. No requirement to maintain anything in that margin account, but call option writers are because of their potential for losses. When you think about what the losses might be for a call option, so this is what it looks like for call option writers. There's your premium, there's your strike price there, and there's your losses. And so they basically, for a call option, they have a potential, essentially it's unbounded loss potential there. And so because of that, the loss could simply mount up, assuming they don't close their position out. Then the clearinghouse requires them to put in money in their margin account to take account of the fact that, they might end up with a significant payout at the end there. The call option, put options, their slightly different is that they're actually limited in both what you can lose and what you can gain. Perhaps you should look at why that is. So if we're going to take call option, put option here. So this is a put option payoff. There's your strike price. There's the premium. And the worst thing that can happen is that the price of the asset goes to zero. And so your gain is actually limited. Okay, if your asset goes down to zero, then your gain is whatever the strike price is. And so for a put, you have limited losses. That's your option price. But you also have limited gains, and your gain is limited to the case that the asset becomes worthless. And then that's your maximum gain. Again, in terms of the margin, no margin requirement if you actually buy the option, but there are margin requirements if you are the writer. And again, from the writer's point of view, this is the payoff here. There's the premium that they would earn, and there's their losses in case things go against them. And so, because of the potential for losses that goes quite far down, they are required to put money in that margin account to cover potential losses. Okay, so that wraps it up. Is there any questions on options before we move on? Okay. So we'll move on to swaps. Now, I'll just dig out my graph that I had the other day. Where did it go? Here it is. Yeah, put this up here. So this is only the U.S. banking sector, so this is not the global market for these options. But that's the size for the banking sector in the U.S. For futures and forwards. This is the options that we've just talked about, and you can see relative to the swaps are the really big ones. That's the biggest derivative that they use, and a small bit here for the credit derivatives. So while these are non-trivial, I mean that the futures and forwards that's about $40 trillion there. The options, again, not trivial, about $33 trillion in options. The swaps is a really big one. In this case, for this data here, there's some around $110 trillion in swaps just for the U.S. banking sector alone. And of course, the orange ones are the four big banks in the U.S., and the blue bits are all other banks put together. So when we start to look at the swaps, this is by far the biggest derivative used in the banking sector in the U.S. And the same true is out here, that the banks, they use swaps enormous amount. Not that these other ones are all trivial in terms of their size, but swaps is one that is by far the largest. Right. What is the time anyway? Oh, it's 5:02. We won't get very far, but we'll get started. So, first question up, what's a swap? What is a swap? very quiet. All these you guys have coming to the end of the term. Oh, yes. I just remembered something. I nearly forgot. I'm sorry. I nearly forgot. Okay. Go back here. When you come back from term break, the first week back on Tuesday, the third quiz opens. Okay. So that quiz will open at 6 a.m. on Tuesday, as per normal, and it will run all the way through to midnight on Friday. So it'll be open for an additional 6 hours that wasn't in the previous ones. The subject matter of that quiz will be from the overview through to the end of the equities. So not the derivatives, basically up to the end of equities will be the subject matter covered. There will be 40 questions in there, okay, 40 multi-choice questions as you've seen before. In this case, they will be split across 2 pages of 20 each. So once you've completed 120, make sure you do that second page of 20. And the time limit for it will be 60 minutes, so it's a full hour to do the quiz. Just like the other times, you're allowed 2 attempts, but again, you required a 2-day gap between the first and second. So if you want to do it twice, make sure you do it early enough to do it, have your 2-day gap, and have your second attempt. If you do it twice, then the higher of the 2 scores will be the score for the test quiz, and it is worth 4% of the final mark. Okay, any questions on that before we wind up? Yeah, I should have put that right at the beginning. Okay, well, in light of the fact that we only got 3 minutes left, I think we'll stop there, and we'll pick, 2 minutes left, and we'll start on swaps first day back next term.